Welcome everyone to the Canadian Hedge Fund Awards Winners Showcase. I'm Dennis McPherson. It's my pleasure to be your MC for the afternoon. On behalf of Alternative IQ, the producer of today's event, the participating hedge funds, and the sponsors, we are all delighted to see such a great turnout of interested investors, advisors, and industry experts. I have been in a few podiums in my day. Usually I'm speaking about subject matter expert type of things, so I will be doing some reading today, so please excuse me for that. But my job will just be to keep the event moving along. We've got a lot of great speakers. Quick note just on my firm, so SGGG Fund Services, one of the, housekeeping item, please make sure your phones are on mute. We were one of the award winners at this year's event for Top Fund Administrator. So we're one of the 4 main fund administrators in Canada. Probably 4 to 5 of the winners of the awards this past year were clients of ours. So we've got a pretty good grasp on the alternative funds marketplace. If you're an investor, just time I'll take up is what's an administrator from your perspective. So if you're an investor, this is the place where your account statements and tax slips and financial statements get prepared. If you're an advisor, that's the place that your team and assistants might be calling to follow up on things that you felt should have happened yesterday. And if you're a fund manager, obviously, then you're our client, and we're taking care of your business for you. So we're proud to be part of the Hedge Funds Award program and giving you the opportunity to hear the views of some of Canada's brightest and best hedge fund managers. Just before we start, I'd like to take a moment to acknowledge all the sponsors whose support makes today's showcase event possible. So I'll start with myself. Thank you, Dennis. CIBC, Prime Brokerage, and Fund Data, who, if you don't know, are responsible for compiling all the data behind the numbers for the Canadian fund industry. So winning a Canadian Hedge Fund Award is the highest honor in Canada's hedge fund industry. Today you'll hear from the managers of 3 winning funds at the 2016 Hedge Fund Awards last October, who are sitting at the table in front of me and to my left here. But first, to kick off today's agenda, Mr. Benjamin Tal, Managing Director and Deputy Chief Economist at CIBC Capital Markets, will deliver the keynote address. Mr. Tal is responsible for analyzing economic developments and their implications for North American fixed income, equity, foreign exchange, and commodities markets. He also acts in an advisory capacity to bank officers on issues related to wealth management, household, corporate, and credit and risk. Well known for his groundbreaking published research on topics such as labor market dynamics, real estate, credit markets, international trade and business, economic conditions, Mr. Tal not only contributes to the conversation, but frequently sets the agenda. He has close to 20 years of experience in the private sector advising clients, industry leaders, corporate boards, trade associations, and governments on economic and financial issues. National and global media regularly seek him out for his insight analysis on economic issues that impact financial markets, consumers, corporations, and public policy. He's also a frequent lecturer in the economic programs of various Canadian universities. Mr. Tal is a member of the Economic Committee of the Canadian Chamber of Commerce, the Economic Development Committee of the Toronto Board of Trade. He's also a member of the Board of Governors of Junior Achievement of Central Ontario, and a board member of the Toronto Financial Services Alliance. So, as you can see from the title of what he's going to be speaking about today, he clearly has a good sense of humor. Ladies and gentlemen, please join me in welcoming our keynote speaker, Mr. Benjamin Tal.
Good afternoon. Listen, we don't have much time, less than half an hour. That's not enough. So I'm going to go through this presentation very, very quickly. So please pay attention. Because you know what? If the real and ultimate measure of intelligence is what you do when you don't know what to do, then the next few weeks, months, and quarters will test the economic IQ of every central banker in the universe, because they are the first to admit that they have no clue what's happening. You know, this level of uncertainty, just to illustrate, not too long ago, I was in Saskatoon. It was a long day full of many boring meetings, and late at night I took a flight home, So I had three options what to do during my flight. One was to read my book, the other was to watch a movie, the third was to calculate the output elasticity of the manufacturing sector to changes in interest rates. So after 20 minutes of back of the envelope calculations, I came up with a number. The number was 0.9. Fine. The day after, I went to my office, I put it in my newsletter and forgot about it. 2 weeks after, I had a meeting with the Bank of Canada, and I meet with the Bank of Canada very often, unfortunately. No, really, they never give you a straightforward answer. They believe in what they call constructive ambiguity. You know, you ask them for the telephone number, they give you an estimate. In any case, we had this meeting, and one item on the agenda was this output elasticity. And to my surprise, their number was 0.9, my number. I must tell you, I was very impressed. You know, after all, they have an army of PhDs. I was doing it being jet lag from Saskatoon. We came up with the exact same number. So after 2 long hours, I couldn't resist anymore, and I asked, can you tell me what kind of assumptions did you use to come up with this number? And they said, actually, we used your number. What I'm telling you here is that the blind leads the blind. Nobody has a clue what's happening. That's where we are in the cycle. And that's why what's happening with Trump is extremely important. Listen, I did not predict that Trump will win, although I should have. I'll tell you why. Because, you know, during the campaign, you have Trump running, you have to use some humor, you have to have some jokes. So whenever I was joking about Trump in Toronto, Vancouver, people were laughing. I was in New York, Boston, Phoenix, nothing. People were kind of nervous laughter. And I remember telling myself, maybe this is bigger than you think. So I should have predicted, I didn't. But let me make another prediction. I predict that he will be a one-term president for 3 reasons. One, I think that after 4 years, he will say, you know what, this is too much work, this is not for me. The second, I really believe that by 2018, 2019, he will be fighting with Congress like there is no tomorrow. We'll talk about it in a second, over that. But the third reason, and the most important reason, is the fact that this problem that Trump is trying to solve, jobs, this problem simply does not have a solution. That's the elephant in the room that no politician will never admit. This problem simply does not have a solution. I'm talking about the mismatch in the labor market. We have people without jobs, and we have jobs without people. And you cannot fix this mismatch very quickly. Every first Friday of the month at 8:30 in the morning, we get the employment numbers from the US. 8:30 in the morning, first Friday of the month. So at 8:29, every economist is sitting in front of his, her computer looking, waiting, anticipating the numbers. Believe me, it's very exciting. And every time we look at the numbers, we look at number and we look at wages, and we don't see wages rising. Let me illustrate. Look at this chart. This is the very famous Phillips curve in economics, namely the relationship between the unemployment rate and wages. Whenever the unemployment rate goes down, wages should go up because the bargaining power of labor goes up. Makes sense? That's the very famous Phillips curve. By the way, this guy Phillips, he got a Nobel Prize for this. Now, that's economics 101. That's real life. Now, I don't know what it is, but it's not the Phillips curve. According to this, the US economy is failing, economics 101. This funny chart is Brexit. This funny chart is Trump. That's the message of those who are not participating in the process of economic recovery. They are not part of the labor market. That's their cry. It's not about China. It's not about Mexico. Manufacturing jobs have been going down way before NAFTA, way before China entered the WTO. For every job we lost to trade, we lost 8 to automation and technology. This is not about China. It's about a mismatch in the labor market. We have people without jobs, and we have jobs without people. The participation rate is down. This means that millions of people are not even participating in the labor market. They're not even looking. That's their cry, and Trump is their messenger. Long-term unemployment. It is now higher than it used to be in the peak of the 91 recession. That's their cry. And Trump is the messenger. When you have more people collecting disability insurance than production workers, you know that something is changing. That's their cry. This is not about people not liking Hillary. This is much bigger than that. So the question is, can we have Trump here in Canada? I think it will be naive to believe that we are totally immune to this trend. The quality of employment in Canada is going down, income gap is widening, and the number of people making less than average wage is rising. We are not immune to this trajectory. And by the way, it's not just about very uneducated people. It's about educated people as well. Listen to this. Canada is the most educated country in the OECD in terms of the number of people going to universities. The most educated country. But we are also the #1 country in terms of the number of educated people that live in poverty. We simply cannot translate those degrees into jobs. And the question is why, and the answer is 2 hours. But one of them is the field of study, what people are studying. It's not enough to have a university degree. We all know that. I met the other day, I met a person, she told me, my son has 2 MAs and he cannot find a job. And I said, MAs in what? The field of study, we know what we need. You look at the distribution of the field of study, it's exact same distribution that it was 15 years ago. Hasn't changed. You know, I gave a presentation somewhere about something else, and a professor was talking before me, and he was telling us about his son. He said, my son, when he was very young, he used to say, I love my room, I love this house, I will never leave this house. Today, his son is doing his PhD in philosophy. So I guess he was not joking. So that's the background. That's the background that we have to understand. This is bigger. And then we have France and we have Germany coming. That's Brexit. It's big. We have to understand that, and we are not immune. So that's the background. Now let's go and take a look at some pockets of uncertainty and see what's interesting and what's not. Now, Trump is inheriting a good economy. The global economy, in fact, in 2017 is going to be better than in 2016. Why? Because we injected so much money into the system. Every central bank was printing money, taking interest rates to negative. You know the story. We have so much injection of money into the system. There is a lot of wind. And if you generate enough wind, even pigs can fly. And that's exactly what's happening. But this is a mirage. We are going to reach the peak of the global cycle by mid-2017 because we don't have enough ammunition. The real story is not an acceleration. That's the real story. That's the real story that explains Trump, Brexit, and what's happening in France. The global economy is slowing down. The potential growth of the global economy is slowing down. This is about demographics. This is about productivity. We know the story. This is not something negative. This is just the reality that we are all operating in. And even Trump cannot reverse it because this is a major demographic force. The speed limit, the running speed of the global economy everywhere is going down. In Japan, in the Eurozone, in the US, we are basically, in many ways, turning Japanese. At least a North American version of Japan. That's something that we have to respect. And interest rates will rise. They will be higher, but they will not be high. That's something that we have to accept because of that. Even in China, although we don't know what's happening in China. Who knows what's happening in China? You know, I know somebody that is an economist at the Central Bank of China, and I asked him one day, between us, tell me, is it true that the Chinese Communist Party is telling you guys what numbers to put in your models? And he said, absolutely not. He said, we have 100% autonomy. Nobody's telling us what to do. We can use whatever numbers we want as long as the answer is 6.5. Because 6.5, as you know, is just the target of the Communist Party for GDP, and miracle of miracles. They are stabilizing at 6.5. It's amazing what they can do over there. Well, I think China is at 4% if they're lucky, but that's a different story. It's going down. It's going down. And that's something that we have to respect. That's a speed limit, and Trump, nobody can reverse it. So given that, let's discuss some other pockets. The Eurozone. I believe from day one, I believe that the Euro was a mistake. Let's face it, you cannot put Germany and Italy together and expect something good to happen. So I do believe that now, never before, have I seen a situation in which so much of the stability, or maybe the very existence of the euro, depends on one person, and this person is Angela Merkel. She's the glue that is keeping this euro together. And if the market is starting to tweet about the possibility of her losing the elections in the fall, the euro is vulnerable. We still have France coming, and the euro is vulnerable. I've been shorting the euro for the past 8 months, and I will stay away until I get the green light from Germany. I believe that France will be fine, and eventually Germany will be fine, and then I will be longing the euro like there is no tomorrow, because the economy there is doing okay, and the ECB will start actually removing liquidity from the system. But between now and then, I'm staying away because there is too much noise, too much uncertainty, given the election cycle over there, especially Germany, which is a big one. What's happening in the UK, Brexit? Well, they voted out, but for 6 months, they had no clue what to do. They were basically trying to figure out what to do. She was really inconsistent, and then in January, she gave a speech and said, we are out. We are out, clear exit. Unfortunately, Trump is now president, and now she has to deal with Trump from a position of weakness. Because under the umbrella of the EU, she could have fought Trump. Now she needs Trump more than Trump needs her. She's in a very difficult position. She's starting to negotiate with the EU a free trade agreement. It's not going to happen. She needs Trump. She wants free trade. He wants something else. The timing of Brexit for her was terrible. So that's the UK. And the UK is very complex. I'm staying away from the sterling at this point, given how complex the situation is. I think at one point the sterling will be a very good buying opportunity. I'm not there yet. China is much more interesting. China now can move markets. I believe that 2 years ago China was unable to move markets because people were operating under the assumption that regardless what happens, the Chinese Communist Party has the monetary might, the fiscal might, and the political ability to deal with whatever happens. Because after all, in China, you don't have to run anything by Congress. You just do it. And then something happened. I remember the market crashed, and we all know that the market in China is nothing more than a casino. It crashed. And the government made the mistake of putting that credibility on the line and try to save not the economy, but the stock market, and you cannot. You cannot save the stock market even if you are the Chinese Communist Party. This crisis is a crisis of credibility, not a crisis of fundamentals in China. And they have to labor very, very hard in order to regain that credibility while doing something very difficult, as you're all aware, trying to get more consumption and less investment, less manufacturing, less exports. Very difficult to do because every small change in the manufacturing base of China is millions of people losing their jobs, and you have the risk of a Chinese spring. And we are seeing already some signs of panic. Look at the red line, that's credit. Credit in China is rising now at 22% a year. And 85% of this credit is going where? It's going to real estate. And we all know that the last thing that China needs is another empty shopping mall. So this is a clear reflection of a government that is panicking. But more than that, If they panic a bit more, and that can happen, they will go to what they know best, and that's the currency. They will try to manipulate the currency to lead to export-led recovery and devalue the currency. We have been to this movie before. You go to China, and I'm sure that many of you visited China, you speak to people, and they will tell you the number one risk for them is a large-scale devaluation of the yuan. And from here, the link to the condo market in Toronto and Vancouver is very clear. You know, I had a dinner with 22 real estate agents and brokers dealing only with Chinese investors. And the reason why I wanted to have this dinner is because of the fact that this is the way you get information about foreign investment. Believe me, you don't get information from Stats Canada. You need to speak to people. So they arranged this dinner for me, and I had many, many questions, and after a few bottles of wine, I got some answers. And I can tell you that the number one reason why money is leaving China is the risk of a large-scale devaluation. More money, not less, will be leaving China. And now we have this tug of war between China and its people. People are trying to get money out of China. The government is trying to stop them, but never underestimate the ability, the creativity of Chinese business people and their ability to get money out through Hong Kong and all kinds of other tricks. They are doing it now, and it's coming here. It's coming to Vancouver, it's coming to Seattle. We are seeing it in real estate and elsewhere. More money, not less, will be leaving China. Very quickly, I'm longing energy. I think that Trump is a friend of the energy sector. Now, we have to understand what's happening in the energy sector. This is basically the supply curve that we're dealing with, which is really three supply curves. One is the cheap one, OPEC, the other is the US, and the third, the expensive one, that's us. The reason why I don't see prices rising significantly is because of US production. It seems that OPEC and Saudi Arabia is now willing to tolerate 50, 55, even $60 a barrel. That's when US production is waking up, and that's why you see production rising, capacity rising, and therefore it will be very difficult to go above $60, where we need to be. So I'm not sure that this is over for Alberta. This is, the fourth, the fifth inning when it comes to Alberta. Yes, activity will improve. Yes, the worst is over, but it's not a V-shaped recovery because the real price manager in the market is really US production. And they have unlimited ability to influence prices through supply. And if Saudi Arabia is willing to tolerate 55, 60, and it seems that they're willing at this point, then they will be very active there. I'm longing US energy first, and then Canadian energy. I think, given the fact that Trump is not exactly green, energy will do well. Let's talk about Trump. Trump has been signing executive orders at the speed of light. Every day he's signing something. Why? Because he's dealing with the easy stuff. You know what? Killing TPP was very easy because TPP was dead. Infrastructure, he's signing a piece of paper. We'll talk about it in a second. Deregulation, happening, but not so quickly. Energy, as I mentioned, Keystone. Personal tax, corporate tax cuts, clearly happening. Even cash repatriation, very easy to do. Building a wall, even easier. Trade is not easy. When it comes to trade, I think that his pen will run out of ink because trade is difficult. We'll talk about it in a second, but let me demonstrate why I believe he will be fighting with Congress. Because everything costs money. And if you are a Republican, even Congress, even Paul Ryan at this point will tell you, you cut taxes, you get the economic growth, and then you don't have to borrow because the debt to GDP ratio will stabilize. That's basically the logic. Makes sense? But for this, you need like 4% GDP growth, and that's what basically they are counting on. They will not get 4% GDP growth. First, you have to fight a very strong downward trend because of the demographic story. Remember the speed limit. But beyond that, the effectiveness of those policies, very limited. First, for example, infrastructure. The mother of all infrastructure spending is coming. According to Trump, that will create 50,000 jobs a year over the next 4 years. Wonderful. But the US economy generates 2.5 million jobs a year. That's a rounding error. That's not a game changer. So this infrastructure boom will not generate much GDP. Then you have the income tax coming. 70 to 80% of it will be going to the top 10%. Namely, those people are not spending, they are saving. Their propensity to spend is very marginal. Therefore, the contribution to GDP will be very limited. What about this $2.3 trillion of cash repatriation? Apple and all those other companies will bring back the money. Wonderful, they will. The way they did in 2004. But most of this money went to stock buybacks. Not to investment, not to hiring. So again, the multiplier, economic multiplier of this will be limited. So what I'm telling you here is that simply he cannot deliver on that because the economic growth that you will get out of it will be half a percentage point, maybe a full percentage point, but not 2 full percentage points. So you will be short. So if I trade Trump, I'm not trading Trump on growth. I'm trading him on inflation because Trump is inflationary. Trump is not Reagan. People compare Trump to Reagan. He is not. Because Reagan, when he started to stimulate the economy, the debt to GDP ratio was 30%. The economy was in a recession and interest rates were going down. Trump, the debt to GDP ratio is 100% already. The economy is at full potential already, and interest rates are rising. Every aspect of Trump's policy is inflationary, and that's why the correction in the bond market is sustainable. More than that, I think interest rates will rise even further because of the debt situation. He cannot pay for it, as I suggested. GDP will not pay for it. He will have to borrow. And that's when Paul Ryan and Ted Cruz will wake up and say, no way. And that's when the honeymoon will be over. But in between, the long end of the curve will respond to increased debt requirements, and that's exactly what we're going to see. That's why I think that the bond market is not a very friendly place. I think that the bond market will continue to correct, and the correction is sustainable. What about trade? I don't think it will move very fast on trade because trade is complicated. First of all, the border tax, the border adjusted tax, the BAT, it's not going to happen anytime soon because it's against WTO, and it will allow Canada and Mexico, and I had some discussions with people from Mexico. You will be surprised. I think that Mexico will be fighting. We are basically looking at Mexico and say, 29% of their economy is the US economy, therefore they will do whatever he says. You know what? You will be surprised. They will fight hard back. And you know what? It's going to be difficult. Trade is difficult because one issue is that not only is it against WTO, but also the ultimate reasoning might be that the cure is going to be worse than the disease. Namely, what he's trying to fix and what he's doing will be worse than what actually is going to get because of few reasons. One is that you impose a tariff or a border tax, you are penalizing the bottom line, the bottom earners. Because it's a de facto tax, yeah? All those plasma TVs that they're buying for $300, they will cost them $2,000. We know the story. China was a major disinflationary force. That was actually a de facto tax cut. You remove that, you impose a tariff, and you raise taxes on who? The lower end of the income spectrum. And remember, those guys are not getting the tax cuts. The top 10% are getting. So he's hurting exactly those people who voted for him. That's not a good idea. But much more important than that, is what we call the shadow price. What they will be missing. The fastest growing segment of the global economy today is emerging markets, but not just emerging markets, the consumer of emerging markets. We all know that. And we see China trying to encourage more consumption. That's the way it's going. I'm talking about the Y generation in China. 250 million young Chinese people who never experienced poverty in their lives. Their propensity to consume is higher than the average American teenager. And what those sophisticated consumers want is not junk. The junk they send to us. What they want is high quality brand name. That's the future of North American manufacturing. And exactly when you have more and more people able and willing to buy your stuff, you are reducing access to their markets by imposing a de facto trade war. The shadow price of reduced access to emerging market consumers will cost the American economy dearly. The cure is worse than the disease. And he knows that, and if he doesn't, he will. What I think he will do what Reagan did when he negotiated with the Japanese. He will go with Paul Ryan and say, move this, this tax adjustment, the border adjusted tax. Start with it. Start cooking. Take 2 years. Don't run the bill, just start working on it. So we know that there is something cooking. And when you know that there's something cooking, and you go to China and Mexico and say, I have this, so let's negotiate. I think that's the way it's going to happen. So it will not be an actual bill, it will not be actually happening, but it will be some sort of potential weapon when they negotiate. To me, that's the way they're going to use tariff and border adjusted tax. They're actually not going to do it, they will use it as a weapon in the background. One point, if you're into financials in the US, why American banks are up by 30% since November 8th? Why? Yes, tax cuts. Yes, the yield curve is moving in the right direction. Why? The number one reason is Dodd-Frank, deregulation. Absolutely. You ask, I did a survey among our traders. Number one reason, he is going to kill Dodd-Frank. And I say, not so fast. It's not so easy. First of all, you need 60 votes in the Senate. You have only 52. And Elizabeth Warren in the Senate, she is running the campaign to save Dodd-Frank. She is very powerful. Schumer is also doing it. There is also an alternative act. It's called the Financial Choice Act. Basically saying, we are not killing Dodd-Frank, but we are saying if you are a bank and you want to be free from all those regulations, like the stress test and all this business, fine, you can do that. But you have to have 10% leverage ratio. Now, the average in the US now is 625. It means that you have to pay 4% leverage ratio in order to free yourself. Not too many banks will be doing it. What I'm saying here is that to the extent that you are longing American financials because of deregulations and Dodd-Frank dying, I will be a bit careful here. Because he will not be able to kill Dodd-Frank the way he will not be able to impose a tariff tomorrow. The market is using all the good news without looking at the bad news, and that's fine. And as long as it doesn't touch it, as long as it's not trying to do it, namely trade or Dodd-Frank, and just keep it the way it is, this market can continue like that, or at least stabilize at current levels for a while. But if we start actually discussing trade, and there is a de facto semi-trade war with China, this market can correct because it is expensive. Very quickly, let me say something about Canada. Canada, we should be booming by now. When the dollar is down from parity to 75 cents, according to Common Sense Economics 101, we should be booming, but we are not booming. We are not booming. The question is why the manufacturing sector in Canada is unable to take advantage of the weak loonie. 3 reasons. One, of course, we lost market share to Mexico. We know the story. Second is that during the dark days of parity, and parity was an economic accident. We had no business being at parity. But during this period, we lost 10% capacity in our manufacturing sector. So now we won't, but we can't, because we have to rebuild that capacity. And the third reason is that 70% of what we sell to the US is going to the manufacturing sector in the US. And we know because of the strong American dollar, which is the opposite of our weak loonie, the strong American dollar is hurting manufacturing. That's the only thing that is not moving in the US. So the strong dollar is hurting them, and therefore we cannot take advantage of our weak dollar because 70% of what we are selling to the US is going to the manufacturing sector in the US. So there are many reasons and excuses. That's why I believe that if the Fed moves 3 times this year, and I think they will, the Bank of Canada will do nothing. Because we have a Bank of Canada with an agenda, and the agenda is a weaker Canadian dollar. Everything that this bank is doing is designed to lower the value of the dollar. Otherwise, why are you cutting interest rates? Are you trying to stimulate credit? You can't. Interest rates are so low to start with, you cannot do that. We have a generation of Canadians that never experience high or even rising interest rates. For them, those extremely low mortgage rates, that's the norm. So it's not as exciting as it used to be. Yeah? You know, low interest rates is like being in a relationship. In the first few weeks, you are so excited you cannot breathe. But if after 5 years you cannot breathe, you have asthma. What I'm telling you here is that monetary policy is asymmetrical. Lower interest rates cannot lift you. Higher interest rates can kill you. As a society, we have never been so sensitive to the risk of higher interest rates. We know that. But the Bank of Canada is cutting interest rates just to lower the value of the dollar. And I don't know if you remember, when they cut interest rates 2 years ago in January, it was a huge surprise. I'm sure that all of you remember. It was a huge surprise. Nobody expected that. They cut interest rates. And by the way, the Bank of Canada will never admit that that's the case. The governor gave a speech and he said, we do not have a dollar agenda. The dollar is off the table. And I say it is never an official policy until somebody officially denies it, yeah? You know, I think it's an official policy. And when they cut interest rates, and it was a huge surprise, huge, it was a shock. I remember I met with Paul and his crew a week after. And the story in Toronto that in a small boutique research company, they actually fired 2 young analysts because they didn't predict that the Bank of Canada will cut interest rates. They fired 2 kids. So when I met with Paul, I told him, in Toronto, they fired 2 kids because they didn't predict that you will cut interest rates. And I said, at the minimum, this rate cut should generate 2 jobs. You know, just to break even. I don't think it generated even 1 job because the effectiveness of monetary policy is 0. And that's why fiscal policy is really the way to go. I'm totally out of time. The bottom line is that we have a friend when it comes to the dollar at the central bank. Pollars will not touch interest rates until mid-2018, and he will allow the Fed to go 75 basis points, even 100 basis points before moving, and this means that the dollar might go down even further, and we're starting to see it already today. So bottom line, just to sum up, we are in uncharted territory. Predicting Trump is very difficult, but I think that common sense suggests that when it comes to trade, he will move very, very slowly, and the effectiveness of his policies will not lift the economy to the extent that they are expecting. This will lead to a debt crisis, and this will lead to highly volatile environment in the second half of his mandate. That's the way I see the situation. Canada probably will underperform the US in 2017 and 2018, reflecting the uncertainty regarding NAFTA, regarding trade. The US will benefit from some of those tax cuts, and that's why the US will rise by 2.5%. We might manage 1.8, 1.9 if we are lucky. So overall, I suggest that clearly this is a transition period that we have to go through. There is a way to trade this madness if we actually read the economic map correctly, because after this mother of all recessions and after this election, what was normal in the past is not normal in the context of today's economy. Okay? Thank you very much for your attention.
Well, thank you very much, Mr. Tal. As always, you've enlightened and entertained, and it's a pleasure to hear you speak. So now we're going to move into the, get through the rest of the slides. So we're going to move into the manager part of the agenda. First up, we're going to be hearing from Barry Allen, founding partner at Merit Asset Management. So they're each going to speak for about 50 minutes or so. We won't take questions after each presentation. However, if you do have questions, please use the cards that you have on the table to record them. And these managers will also be participating in a panel discussion after the break, and we'll make sure that your questions get addressed at that time. So Barry Allen has over 30 years of investment experience and has successfully operated in virtually all areas of the fixed income arena. Prior to founding Merit, Mr. Allen spent 6 years with Altamira Management, where he managed a wide variety of fixed income mandates and held secondary responsibilities on several equity and balance mandates. He was also responsible for internal risk management and oversight of the hedging activities for the company's balance sheet. During this period, he was the lead manager of the High Yield Bond Fund, co-manager of the Balanced and Growth and Income Funds, and lead manager of the Global Bond and Global Short-Term Income Funds. Barry also managed several institutional mandates with alternative investment strategies, swing funds shifting between Canada and global bonds, a hedge fund being long and short global bonds and currencies, commodity derivatives and equity portfolios, bonds with embedded options to gain convexity. Barry has an undergraduate degree from the University of British Columbia and an MBA from the University of Arizona. Ladies and gentlemen, please welcome me welcome to Barry Allen.
Okay, see if I can make this thing work here. Good afternoon, thank you all for coming. And I think if I interpreted Benjamin's comments correctly, he said the one thing he likes in the financial markets is US dollar cash. And I tend to agree with that. And I'll we actually designed a fund around similar type of things. And so I'll go into that. But what I should say, make sure I know how to work this. Oh, to the left one? Okay. I'm going to talk specifically about a fund that actually didn't win the award. The fund that won the award is our investment grade fund. And we'll go into this particular fixed fund because I think it's very timely in where we are in the economic cycle. But I'm going to skip through a thing. What I will do, this is just our team. I'll make a brief comment on that. You'll see that we've got generations covered. We have the people with gray hair. We have the people with no hair. And we have the people at the bottom that haven't figured out how to shave more than once a month. So maybe the solution to that is that you probably should short Gillette or something. But what I really want to talk about here is a fund that we designed just about 2.5 years ago. And one of the things that I like to do is go to our largest pension funds and family offices and people who are stewarding large pools of capital at the end of every year, and I ask them what's their largest problem. And interestingly enough, for the last 3 years, I've got the exact same answer from every single person I answer. They go, we don't know what to do with fixed income. Rates are at zero. They can only go up. And if they go up enough, they'll kill the stock market, and my diversification strategy won't work because stocks and bonds will go down together. So I'm really worried about fixed income. And the other thing they're worried about is their job. Because I asked them, well, what did you do in the past? Because most of these people have been doing this for 20 to 30 years. And I said, when you're in this situation in the past, what did you do? And they said, oh, it was really simple then. What we did is we raised 15 or 20% cash. We invested it in T-bills and made 5% return and waited for a 20 to 25% correction in the stock market. Then we sold our T-bills, we went back into the stock market, and everything was good. And so I said, well, so why don't you do that now? And he said, well, if we put 15 or 20% of our portfolio into cash, which yields 0, if we're wrong, the drag on the portfolio would be too severe and I would get fired. I said, well, okay, well, we don't want to recommend anything to do that you get fired. So that made me, when I consistently heard this story, we sat down and said, okay, what we really need to do is find a strategy that provides enough yield that people are comfortable selling higher volatility assets and moving into it, and that yield that I kind of made up was around 4%. He said that people were willing to sell riskier assets like stocks and high yield and so on if they could go and be assured of making 4% with a dramatically less risk profile. So we went away and started to try and figure out how we were going to do this. And we reverse engineered something. We said, okay, we want to make 4% return, and we want the risk to be not exactly cash, because that's impossible, but cash-like. So we wanted to have a maximum duration of 2 years and a maximum volatility of 3 years. So if you look at a maximum duration of 2 years, a DEX normal fixed income mutual fund or a DEX mandate would have a duration somewhere around 6 to 8 years. This would be about a third of that. And volatility, at 3% volatility, high yield is about 10%, and the stock market's about 15%. So you'd have volatility about 20% of the equity market, and maybe 30 or 35% of the more higher volatility fixed income. So we thought if we could do that, then that would encourage people to do what they wanted to do. It was to take less risk, but still generate a 4 to 4.5% return. So we designed this fund. The fund, we called it Enhanced Tactical Fund, and we've run it for 2.5 years. We've actually exceeded all of our risk and return parameters. So our goal was to produce a 4% return. We've essentially produced a 5% return. Our goal was to have a maximum duration of 2 years, and our average duration has been roughly 0.8 of a year. And right now we're at 0.4 of a year because we think bond yields are rising going into the Fed meeting next week. And we've had a volatility which is around 1.8%, which is about 60% of our 3% goal. And if we look at the world today, so right now if we look at the lineup of funds we have, one is a cash substitute enhanced tactical, and we have an investment grade long short fund, we have a high yield long short fund, and then we have distressed high yield, which is very specific to one point in time in the credit cycle. Last year we did energy because energy was very, very cheap. This year we're looking at healthcare as a distressed opportunity, and probably next year US retail is going to be the distressed opportunity. But distressed is very specific to where we are in the credit cycle. And we think we're very late in the credit cycle. I mean, if you look at the world, we're 8 years into a cycle that averages 6.5. Is this cycle is supposed to be longer because of central bank activities? Yes. The Fed is raising rates like they mean it this year. They said they were going to raise rates 4 to 5 times last year, and they managed to get one in December. This year they say 3 times, and we take them at their word. We think they're going to do it 3 times. So they're actually getting to the point where they can raise rates. The implications of that for the US dollar and the economy are very uncertain, as Benjamin talked about. We're not super bearish on markets. We don't think that a recession is imminent in the next year, but we also think that uncertainty is virtually as highest as we've ever seen. In my 35 years in the business, I've never seen as many factors that are uncertain as to what could happen. And that shouldn't be, confused with bearish, because we're uncertain. If I was bearish, I would be certain, I guess. But there is an amazing number of things that we don't really know what the outcome is going to be. We don't know what Trump is going to do. We don't know what the impact of the elections are going to be in the Netherlands and in France. And next year in Germany. We don't know what the impact is going to be of the Italian banking crisis. We know that the Italian banks have high degrees of insolvency. They need to get fixed. It's hard to fix them because all the rest of the banks, when they became insolvent in 2008, the governments gave them a whole bunch of money and resumed solvency under the Maastricht Treaty and so on, and the rules of the euro. They can't do that. The EU won't allow the Italian government, even if it could afford it, which is questionable, to recapitalize the Italian banks. So we don't know how that's going to play out. We don't know what the impact will be of a rising U.S. dollar on global trade. Historically, it's been negative. And we don't know what the impact of the Fed raising rates is going to be. And we don't know when the ECB is going to stop QE and start to, or at least start to taper it. And the same thing in Japan. There is greater uncertainty, as I said, than I've ever seen. And that's for that reason. Whenever uncertainty is very high, we want to reduce volatility. And what we have designed this fund is a combination of midterm investment grade bonds, hedged with short positions in Government of Canada or U.S. Treasuries to create zero duration investment grade credit. And the other 50% is in very, very short duration yield to call high yield bonds, because we don't want to take a lot of duration risk with credit. What a lot of people have done, they said, okay, interest rates are going to rise, and therefore we want to exchange duration or interest rate risk for credit risk. And we agree with that to some extent, but what we don't want is long duration credit risk, because that's just exchanging one risk for another risk. And if we suddenly had a recession, credit spreads would widen significantly, and if you have long duration exposure to credit spreads, you can lose a lot of money in doing that. So what we wanted to do is both reduce duration, and we've reduced that, as I said, to under 1 year, but our spread duration or our exposure to credit spreads is also very, very short duration. In the high yield area where credit risk is higher, in the investment grade area where credit risk is lower, we're willing to take a little more. So essentially what we've done is we've created a cash substitute. We can do it in US dollars or Canadian dollars. It's produced a 5% return over the last 2.5 years, and it has risk characteristics that are virtually lower than you can find anywhere else. And it's not designed to be an investment strategy per se. It's not something you will be in for the long term. It's designed to allow people to reduce risk and to move into an area and still realize a reasonable 4 to 5% return while you're waiting for valuations in risk markets to improve to levels that are much more reasonable than what is the case today. So that's all I really wanted to say about that. I know we're a little bit behind schedule, so I'll turn it over to Jason or whoever the next, you'll do that? Okay, thank you.
Thank you, Barry, for those insights into your firm, your process, and your award-winning investment strategies. Our next presenter, Jason Landau, Portfolio Manager, Waratah Capital Advisors. Jason joined Waratah from TD Bank's dealer TD Securities, Inc., where he'd worked as an associate in investment banking and equity capital markets since 2006. During his time at TD, Jason was involved in domestic mergers and acquisitions, as well as the structuring and pricing of equity securities, convertible debentures, and preferred shares. Mr. Landau has received his HBA from the Richard Ivey School of Business at the University of Western Ontario, and Jason received his Chartered Investment Manager designation in March 2013, and was registered as an advising representative in December 2014. Please join me in welcoming Jason Landau.
So today we're going to talk about the energy fund. We have a Waratah. It's creatively named Waratah Energy Fund. So we'll go from there. And my compliance department would kill me if I didn't say we didn't have a disclosure in here, didn't make it away on the deck. So please check out the piece of paper you have on the tables in front of you. And I think he wants me to tell you we can change any number in here at any time. So who are we as a firm? We're a Toronto-based manager. We manage $1.2 billion across 5 different strategies you see at the bottom. There's 27 of us working across the investment team, compliance and operations, as well as our investor relations department. We primarily run long-short strategies that you can see here across the bottom with a real institutional focus on risk management, and that's really what we're delivering. So today we'll talk about the Waratah Energy Fund, as you see on the right-hand side here. Here's my bio. I won't get into it too much. So Waratah Energy Fund, what are we trying to do? It's a long-short fund specific to energy, North American energy. About half our capital is deployed in the U.S., half of it's deployed in Canada. We're targeting a 10 to 12% return over the long-term investment cycle. We think being a specialist in the space is very important and gives us an edge and a competitive advantage to a generalist who's working across and investing across multiple sectors. And we'll get into it in more detail, but think about technology, electric cars, and what's changing in the marketplace today. And the last thing, what we're trying to do, we're trying to dampen volatility. So volatility of our sector is 15%. Since we started investing in the space in 2012, that's a rather large number and has had 40% drawdown. So I know I have a lot of my own money invested in the fund. I have no interest in seeing my own money go down 40%. So we're really trying to mitigate that drawdown. So here's a perfect example, a case study from the beginning of 2014. So it feels like a distant memory, but the first half of 2014 was pretty good for energy. Oil was $100. The XEG was up 23% from January 1st to June 30th. The world is great. We ran 11% net long over that time period and generated an 11% return, gross return. In the second half of 2014, it was a 40% drawdown peak to trough. We ran 9% net long over that time period and had a 9% positive return. So making money in the up and making money in the down. And then, of course, you can see what happened from the middle of 2014 to what was early 2016 until oil turned. There was a 46% drawdown in the markets over that period of time. What we're trying to do is deliver a stable return profile that you can see with the Waratah Energy return of 37% since that time. Here's the stats on a little longer term basis, and you can see the graph, but I think the data in the middle of the page is what we're particularly proud of, and particularly the right side, which is risk. So our volatility is 6.2% for this fund, and as I mentioned before, the 50/50 index of North American energy indices is over 15% over that same time period. The max drawdown for the energy indices is 39%. Our max drawdown is 5%. So why volatility management matters in this space? Well, this is the price of oil. We all know what's happened. It was $100 for a long period of time, or at least felt like that, but it also feels like a distant memory. So in Thanksgiving 2014, Saudi Arabia adopted a market share strategy. They basically said, we're the lowest cost producer in the world. We're not conceding our market share to the US frackers, so we're going to go steal share back. How are we going to do that? We're going to cut price and drive everyone else in North America out of business. And that's sort of what they did. There were 100 bankruptcies in the US since 2014, since the downturn here. Canadian, we'll call it greenfield development in the oil sands, has all but slowed to a crawling halt. And so we have it that oil is kind of fluttering between 50 and 55 today. And there's been a lot of events over that time period. So, but the one I'll point you to is OPEC changed its strategy in the end of last year. So I call it the surprise event at the end of September of 2016, where OPEC kind of met behind closed doors and agreed to cut production to be announced at the next meeting, and most importantly, where non-OPEC members agreed to it too. So Russia and other key countries agreed to cut it, and hence we had a rebound from kind of high 30s to $50 where we are today. So the world's a volatile place. What do we do? And there's a lot of things that we have to think about, and hence being a specialist in the sector allows us expertise. So, you know, you have to deal with Trump, you have to deal with border tax issues. Rex Tillerson, the former CEO of Exxon, is now the Secretary of State. How do you think about U.S. shale production? How does that translate to Canada? OPEC compliance, how do we deal with Russia, and so on. So, but the list goes on. So we have a bunch of geopolitical issues as well in oil. So, you know, top left, what's Saudi Arabia and Iran's real kind of motivations and friendships or, you know, enemies? So how do you think about that dynamic? How do you think about Russia's true motivations behind what they're doing? Why are they cutting production? Well, the ruble fell pretty materially, so when you sell a price, your highest export and highest priced item in US dollars, and it keeps appreciating every day, feels like that's the right commodity and product to continue to sell. And then how do US and Saudi Arabia intentions and interactions work, and what are true motivations there? So there was one theory I heard that Saudi Arabia took upon their market share approach and didn't cut production back in 2014 with the reason of solely getting back and sticking it to the US for sanctioning or for lifting the sanctions on Iran. So that's kind of a theory out there. There's also many theories out there that Saudi Arabia in itself is buying oil at $51 and propping the price up today. So who knows what's really going on, but there's a lot that we have to deal with. And then technology is really the biggest thing I'll point to. So fracking. So fracking to me is pretty amazing. We're drilling 3 kilometers underground in Canada, and we're extending 3 kilometers horizontally. So imagine going for a 6 kilometer run. You know how tiring that is? And then you're drilling 6 kilometers total depth throughout Canada. In the US, they're drilling 2 miles deep and 3 miles long. It's just a staggering amount. The water involved for fracking is quite incredible, and then the sand component, it really blows my mind. So they are filling 140 rail cars full of sand to hydraulic fracture one well. So think of the logistics involved of not only completing a single well, but, you know, 100 or thousands of wells in a single year. And then electric cars. What does it mean? When's peak oil? How do we know when gasoline demand stops? How do we know when it changes? Battery-powered technology will get better, but what does that mean over the long term for oil demand? So what's our investment approach? Number one, we don't forecast commodity prices. Experts predicted $200 in 2007. They also predicted $20 in 2016. We both know how those outcomes fared. So what we do is we react to markets and we adapt. It feels to us today that we're in a $50 to $60 price environment. Our book and our portfolio is designed to weather the storm of each of those scenarios, and we think we make money in that band. But we'll be very reactionary and listen to what the market has to say to us. So we invest in quality. We much prefer High-quality management teams with low balance sheets and low cost structures, one that can really weather the storm. Someone that's built two previous oil and gas businesses and sold them for a healthy profit, that holds a lot of weight in our mind, and we're willing to ascribe a premium valuation for a business like that. So we have a pretty defined approach in how we assess quality, and I think what's different from us and how our investment approach goes, we think our investable universe is about 150 names across North America, and that's E&P, so exploration and production, refining, infrastructure, and services. And again, it's Canada and the US. What we do is we take every single name in our investable universe and we tier them 1 through 4. 1's the best, 4's the worst, 2's and 3's are in between. What goes into the tier determination is entirely subjective, but are all 5 of the criteria you see on the screen. So it's scale. To me, how big is your asset base? And it's as simple as building a DCF. If your DCF goes on for 50 years, that's worth more than a DCF that goes on for 5 years. 2 would be management. So like I spoke about before, how much value do you place in the current team? Have they created value for shareholders in the past? 3 is execution. So do you hit your numbers? But numbers to us are a bunch of things. Do you hit your production numbers? Do you hit your cash flow numbers? And most important is capital. So it ultimately is return on capital employed. So imagine owning a business and 30% of it disappears every year. That's exactly what oil and gas companies have to live with. So there's so much capital that goes back in the ground just to get back to status quo or where you were on January 1st of every year. Cost structure. We like clean balance sheets and clean cost structure. You got a low cost structure, you weather the storm that we're in today. Companies that are pretty aggressive or outsized cost structures at $100 oil obviously didn't fare too well and probably were one of the few in the 100 companies that went bankrupt over that time. So if you get all 5 check marks on our little tier determination, you get a tier 1, you get 2 and 3 X's against you, you go in the tier 4 bucket. We tend to be long tier 1s, we tend to be short tier 4s, and we will use tiers 2s and 3s to hedge our book. We know that in a perfect world, and I had my own capital and went to the beach for 10 years, I think being long a tier 1 and short a tier 4 makes a lot of money. But there's times in the market where it ebbs and flows, and levered names will outperform. So we may be long tier 1s, short some tier 2s to offset that exposure. We may be short some tier 4s and long some tier 3s to offset those exposures. Here's a little case study. 7 Generations was our single biggest winner last year, actually reported this morning. It's still a sizable position in our portfolio, but you can see, it's a little faint, but it gets kind of all 5 check marks that you see on the left-hand side for all the criteria that we pay attention to, and does go in that tier 1 bucket. So number 3 is we hedge unwanted exposures. So the way I always think about how we design our portfolio is from the bottom up. We're fundamental stock pickers. We like names we put on the long side. Names we don't like, we put on the short side. But there are risks that come from doing that. So for example, if we happen to like oil stocks and we happen to dislike natural gas stocks, those are not good hedges for one another. They're 2 separate commodities, trade in 2 separate markets, and they react very differently. So if we like oil stocks, we'll go searching for oil shorts to offset that exposure. If we like natural gas shorts, we'll go look for natural gas longs to offset that exposure. We're willing to take a tilt to the portfolio, but nothing too drastic. So here's a little factor hedging case study, and we think a lot about factors. So I mentioned kind of commodity factors, but think of market cap size, so being long a large cap, short a small cap, not good hedges for one another. So in a 7 Generations is an Alberta-based company. We think it was the fastest growing E&P company in North America last year. Will be one of the top growers this year. We think the street is wrong in terms of their estimates, so both on production and cash flow. So really what we're doing is we're buying a stock cheaper that we think than the market deems it to be. So hence our upside. In a perfect world, we get exposure to just that theme. The stock's cheaper and we get upside to it. But we know that owning 1 share of 7 Generations gives us a lot of inadvertent exposures. Those inadvertent exposures are the slices of pie you can see around the long 7 Generations. So going counterclockwise, you get oil price risk, you get natural gas price risk, you get Alberta royalty risk when that was an issue in 2015, and so forth. On the right-hand side of the page, you'll see all the names that we are short to balance out those factors. So what we're trying to do is isolate our core fundamental thesis that we have, and any changes in oil prices or gas prices are hedged out along the way. So the current positioning, where are we now? OPEC's kind of put a floor, but it feels like somewhat put a ceiling in the market too. So what does that lead us? We think we're in a $50 to $60 world, not too dissimilar with some of the other comments made today. We think the book is designed appropriately for that. So the long side of our portfolio is concentrated in companies that have low cost structures, low balance sheets, and generate high levels of return. What we want is every incremental dollar of cash flow that a company generates, we want them to put it back in the ground because it's the best rate of return on their asset base and best rate of return for the business. Where the short side of the portfolio is largely concentrated on businesses that any incremental dollar cash flow has to be repatriated and put back on the balance sheet to repair high debt leverage that these businesses have. So that's generally how the long and the short book hangs together. And we think typical long-only energy funds are going to struggle in this market with a really range-bound environment and in some sort of direction to make money. Here's a sample portfolio of what we're looking at. You can see it's segregated by country and then the long and the short side of the portfolio. The little numbers to the top right of every logo would denote the tier that we spoke about earlier. So you can see we're both long tier ones and short some tier ones, and it's balanced across Canada and the US. So conclusion, what are we trying to do? We're trying to develop and generate a 10 to 12% return over the long-term investment cycle. We think being a specialist and really understanding the space, think technology, think logistics, think just the changing world that we've all spoken about. And lastly, it's volatility management and protection of capital. So it's an inherently volatile sector. We're really trying to take out that volatility with a 6% volatility relative to the market, our market at 15. So there you go.
Well, thank you, Jason. That was a very enlightening, with a unique and interesting perspective on investing in the energy sector. It's easy to see why your fund was an award-winning one. Our final presenter for this part of the agenda would be my Raj Tandon, founding partner, COO, and head of business development for Algonquin Capital. Prior to founding Algonquin Capital, a boutique alternative fixed income manager based in Toronto, Raj studied mathematics, traded credit derivatives, and volunteered for numerous charitable organizations. As a structured credit trader for TD Securities London, he managed and traded multi-billion-dollar portfolios across North America and international markets. In this capacity, he managed a variety of complex risks, including probability trading, the bank's CDO portfolio through the tumultuous markets of 2008. Outside of work, Raj has a passion for community service. In 2009, he was awarded Get Connected's Volunteer of the Year for his work on a children's helpline. Most recently, Raj spent 18 months volunteering for microfinance and development projects in South America. Mr. Tandon received his MA in pure mathematics from Columbia University and his Bachelor of Science in Philosophy and Mathematics from the London School of Economics, first class honors and first in class. Ladies and gentlemen, please join me in welcoming Raj Tandon.
Thank you, Dennis. I'm going to start off with a confession. When I was preparing this presentation today, I really struggled with where to begin. I had a good idea of what I wanted to share, I just couldn't decide where to start. Well, we'll start with the disclaimer because that's very exciting. Yeah, okay. Perhaps an even more embarrassing confession is in the end, I actually got my inspiration from The Sound of Music. Now rest assured, I have no intention of singing for you today. But as the great Fraulein Maria once said, start at the very beginning. It's a very good place to start. So the very beginning of Algonquin Capital was three guys in an office about the size of a closet planning to launch a fund based on one simple, age-old idea: robbing banks. My partners and I simply saw the opportunity to take the strategies we used to execute for the banks off of the trading floor and into the world of alternative asset management. And in doing so, offer investors an opportunity to gain access to absolute return fixed income strategies that could provide them with important portfolio diversification. Now, we all know every good heist story starts off by introducing the characters. And characters is a good word to use when you're describing our team. My partner, who's here today with me, Brian DaCosta, and who will be speaking in the panel, is a former captain in the armed forces who went on to do an MBA, and that landed him on Bay Street, where he enjoyed a 20-year career, including running TD's interest rate derivatives business, and then moving on to CIBC, where he was a global head of fixed income and rates. Now, our other partner, who we like to affectionately call Mr. Greg Jeffs, is the firm's chief investment officer, and the legend is that he was born on a bond trading desk. He's been in the capital markets for 25 years, having spent the last 20 years as CIBC's corporate bond trader and market maker. Suffice to say that there are very few people in Canada with his knowledge of the corporate bond market. And as Dennis alluded to, as little old me, I finished my master's in pure mathematics and joined TD Securities in the UK, where I managed a portfolio of credit derivatives. So once the three of us managed to escape the banks, one thing became very apparent to us. We needed to, in order to actually sell our merchandise, in order to gain any traction in the marketplace that was full of investment products, we needed to solve a difficult problem. And given our backgrounds, the natural fit was a low interest rate environment. Now, I don't assume anybody in this room needs a graph to remind them that interest rates are low. And with interest rates at historical lows, it's great for borrowers, but rather difficult for investors. First of all, it's pretty hard to make good returns right now. When interest rates are at 5%, earning a target return of 7 isn't so difficult, as opposed to today when the 5-year bonds are trading at 1%. Secondly, in talking to many investors, we realized something pretty quickly. A rise in interest rates could be quite painful, from losses in real estate, high dividend payers, prefs, and not to mention the impact that it could have on other asset classes. So with these in mind, we designed and created a fund that could generate 6 to 9% absolute returns through fixed income strategies that could produce no matter if interest rates rise, fall, or stay the same. So case in point of the challenge that we were trying to address is the Canadian traditional fixed income market. Right now, the yield on the Canadian Universe Bond Index is 2.1%. The duration on this portfolio is 7.3, which means a rise of 1% in interest rates could lead to a 7.3% loss. Doesn't matter what your views are on interest rates, the risk-reward profile is not very attractive. So what we look to do is to isolate the credit exposure in a corporate bond while managing and hedging the interest rate exposure. Now, perhaps the best way to explain what we do is with a simple example. So let's start off with a Bank of Nova Scotia 3-year subordinated bond. Now, let me disclaimer here, I'm not playing favorites with any of the banks. It's just a hypothetical example, and I've kept the numbers round to keep the math nice and simple. So a traditional portfolio manager will go out and buy this bond, hoping to earn the 2.5% a year. What we do is we'll buy that bond and simultaneously short the government of Canada against it. What we've done by doing this is hedge out the interest rate exposure. So now when interest rates move up or down, the two positions offset each other. So for example, if rates were to go up by 1%, the loss on the BNS bond would be offset or balanced by the profit on the short sell of Canada. And having taken out the interest rate risk, we've also done another thing. we've taken out the main driver of volatility in bond prices. Around 80% of the volatility in a traditional fixed income portfolio is driven purely by fluctuations of interest rates. So having taken out this exposure, what we're left with is the credit spread. This is the excess yield that the Bank of Nova Scotia must pay its bondholders in order to hold their 3-year subordinated debt. And through our experience and analysis, we believe that this, in an investment grade universe, the credit spread is compensating investors very well for the risk and the volatility. Furthermore, credit spreads tend to be rather sticky, and in more technical terms, less volatile than other asset classes. So having isolated the value where we see a strong risk and volatility profile, and having hedged out the unwanted risk, we apply modest leverage to the hedge package. So typically we'll be running about 4 to 5 times leverage, and in building a diverse portfolio of credits in this nature, we're able to achieve a leverage yield of between 5 and 7%. Now, usually our portfolio will consist of about 50 to 60 positions of this nature, with the majority of it focused in investment-grade credit. Actually, right now, I'd say since inception, we've run 90% investment grade. And typically, the duration of the portfolio, the credit duration, sorry, I should clarify, is under 3 years. So now, when we're building our portfolio, we tend to have 3 layers to our strategy. The bottom layer is the core credit. Here, as typically the maturity is maxed out around 3 years, and here we're looking at valuing the corporate credit spread as a compensation against the risk. So typically here, we were holding our positions for the longer term. We might not mature them, but here, as we've said to ourselves, the credit spread is providing a good compensation for the downside risk and the volatility we can experience on that position. The next layer of the cake is our active trading strategy. Here, we're not only looking at the yield and saying we like the yield on the bond or the credit spread of the bond, we also can see the potential for performance on the credit spread. So for example, this is when we see a sector or an individual credit or even an individual security or even a relative value trade where we expect to get actual performance on the credit while earning the yield from holding the position. These typically will be held anywhere from 1 to 6 months. And then the icing on the cake is the tactical trading. And here we look to take advantage of the opaque nature of bond markets and factors such as momentum, technicals, new issue trading. And then in that bucket, we're typically holding positions from anywhere from 24 hours to 1 month. So in building this cake, the positions that we hold, as mentioned, generate about a 5 to 7% return for us, or yield. And on top of that, the next 2 layers between active trading and tactical trading, we're looking to make a gross return of about 2 to 5%. And that gets us into our target range of 6 to 9%, regardless or irrespective of what happens to the interest rate world. Now, the typical question that pops up around now is, you said to me you target 6 to 9, yet your returns are much higher. What gives? So to be very, very honest, in 2015, we launched with pretty much our own money. And we were able to capitalize on our size and generate a tremendous amount of excess return through our active trading and tactical strategies. In 2016, we managed to earn that range of around 5 to 7% from the yield on our portfolio. And the year-over-year performance in credit probably kicked in about another 6%. Where we were able to generate even excess returns beyond that was by efficiently executing, I should say, our risk management framework. And that helped us to avoid losses in the beginning of the year when the market took a turn for the worse, which resulted probably in another gain of about 4 to 5%. On top of that, we had active credit selection and excess returns generated from our tactical trading strategies. Now, given that I'm the last speaker before the break, I'm going to spare you any witty or interesting conclusions and just say thank you all, and thank you very much to Julie for organizing this event, and I hope you enjoy the rest of the afternoon.
Thank you, Raj. Clearly another example of what it takes to be an award-winning fund. We really appreciate your insights. So we're now going to take a break. There's some coffee and refreshments at the back of the room. Also, if you haven't already done so, please make sure you put one of your business cards in the bowl on the table at the back there. There's a nice draw for a Bluetooth keyboard and accessories. So we're going to reconvene back in our seats at 4 o'clock, which gives us just under 30 minutes. Thank you very much. And now, our award-winning hedge fund managers will discuss in more detail and debate the issues that are no doubt on everyone's mind. To moderate this discussion is Brooke Biscoe, Vice President Business Development at Fund Data Canada. Brooke is a top-performing sales professional with over 15 years of experience selling innovative investment management solutions to multinational corporate clients. He's been with Fund Data Canada for 8 years, where he's responsible for the sales and marketing of data products throughout Canada to the financial service industry, in addition to the development and pricing of new products to meet the changing needs of fund companies, dealers, banks, and insurance companies. Mr. Biscoe has delivered consistently strong sales results within an intensely competitive market. He's skilled at building enduring client relationships and growing key accounts, and has impressive technical expertise in investment and asset management and pension plan design. Mr. Biscoe has an industry-wide reputation for integrity, ethics, and professionalism in all dealings. Previously, Brooke spent 18 years at Canada Life, where he was responsible for pension investment sales and marketing to institutional clients. Mr. Biscoe started his career at Royal Bank of Canada. Ladies and gentlemen, please welcome to the podium Brooke Biscoe, and back to the table here are our award-winning fund managers.
Thanks, Dennis. As I said, the panel will be discussing the allocation of alternative strategies to improve portfolio performance. In the unpredictability of today's financial markets, many investors are seeking new ways to reduce the impact of market volatility on the portfolios. Hedge strategies have the potential to help investors weather the volatility. We've seen in some of the presentations earlier today about the growth that we're seeing possibly in the Canadian marketplace, and all three managers have really, in their presentations earlier, have talked about how their active strategies are really going to be a benefit to you, as opposed to so much we're seeing today in passive management. So Julie had put together a couple of slides that really show how hedge funds strategies over the years have performed better performance at less risk. And the other slide is really just showing how in various market times the hedge fund strategies have actually done better than Canadian equity. So without further ado, I'm going to sit down and we're going to have a panel discussion with the three managers. And is this one on? Is this one on? Yeah. Oh, it is. Okay, sorry. Barry DaCosta is the new person on the panel, and Raj, his colleague, had given most of his resume, but I'm just going to add a few things that he is, as he mentioned, had been a captain in the Canadian Armed Forces and was awarded the Chief of Defense Staff commendation for exemplary leadership in the peacekeeping services in Iraq. And when Barry's not in the office, he can be found in the gym, at the hockey rink, or undertaking an ambitious garden project. And that'll be interesting to hear about that back in the springtime, but we'll leave that for another time. Okay, sorry. Barry got his MBA from the Richard Ivey School of Business at the University of Western Ontario, a gold medal winner, and his Master's of BSc, I should say, Engineering Science from the University of Toronto. So please welcome Barry to the panel with Barry and Jason. So the panel is going to be broken up into sort of three categories: setting the stage, cases for hedge funds, and also the winning hedge fund strategies. So I'm going to start off by asking the three panelists here, what are the key strategies facing Canadian high net worth investors today. And I will start with Barry, and we'll work across Jason and to Brian.
Okay, well, I think that the things that are most topical of all the high net worth people we talk to really center around valuations and where we are in the cycle. The S&P broadly is at multiples that are close to records. We're at record highs in absolute terms. We're 8 years at least into this cycle. The Fed is raising rates, all those kind of things that I think are on the radar screen of high net worth investors. So what can they do to still generate a return, but be cognizant of the fact that the risks are certainly a lot higher, much higher than they would be if we were at the beginning of a cycle and multiples were low, and we come off a couple of negative years and so on. Cyclically, I think that's the challenges that the high net worth investors that I speak to, is how to deal with valuations but still get some kind of reasonable return without taking too much risk.
Yeah, I would echo the same points. We hear a lot about valuation, and S&P 500 is at peak. I think we're 18 times earnings, and it hasn't been there for a long time. So that's the kind of the challenge that we hear. But we think kind of the sleep at night, low volatility approach, that if you do have a drawdown in the market, you'll be able to protect your capital is kind of what we try to preach to our high net worth investors.
We get a slightly different question, but it is related to valuation. The question we tend to hear, it's centered around how do I get properly diversified? And what people have noticed is certainly over the last 10 years or so, correlations between the markets, certainly the global equity markets, but even within between fixed income and equities, the correlations are not what they used to be, especially in a crisis. Correlations tend to go towards one. And so having a diversified portfolio in 2008 really didn't, all global equity markets went down. So it was a bit of an eye-opener. So I think that's a challenge that a lot of high net worth individuals are looking at, especially since they also kind of figured out that their portfolios are highly sensitive to interest rates. Right? Whether it's through the asset classes they own, or a lot of them own a lot of real estate, whether it's commercial or not. So they're looking at how do I protect myself in an environment where things look expensive, everything looks expensive.
Thanks, Barry. The Canadian hedge fund industry has continued to mature, growing from its origin in resource and energy-focused long-short equities funds to embrace a wider variety of hedge fund strategies. How do you see these strategies evolving? And I might start with Brian.
Well, I think we definitely are going to see a continued expansion in the type of products. The long-short equity guys were the pioneers, let's say, in the space, and probably the global macro folks. I think what we're starting to see now is actually people taking advantage of the fact that banks are exiting or pulling back from varieties of businesses. So I think you're going to see a lot more funds starting up along the lines of private debt funds. You're seeing or innovative lending, let's say. I think one of the most interesting managers I spoke to was somebody, you must be aware of the peer-to-peer lending platforms that are the rage in the U.S. Well, these folks have got a fund that actually provides the capital to the peer-to-peer lending platforms. And so you're like, wow, I never even thought of that. And so what's happening is they're being able to bring completely differentiated revenue streams, almost like businesses, right, to investors. And I think that's a trend we'll see as that trend will continue.
So I'm up here, of course, because I run a long-short energy fund. So I guess not too far from where the roots were grown. But I think we're a little different in that we're running a true market-neutral approach to a sector, and the sector's incredibly relevant to Canada, represents 20% of our index, and think about how much of our economy is driven from this one sector alone. So it's more, I think, the trend towards more market neutral, more true hedged funds. I think resource funds, or at least the hedge funds that call themselves hedge funds kind of 10 or 15 years ago were $95 long and $5 short. Well, that doesn't really feel like a true hedged fund. So what we're truly trying to hedge risk and think about it along those lines.
Yeah, well, I would say that that the perception is that Canada's hedge fund industry was primarily long-short energy or resource equities, when in fact I don't think that's quite true. I think the original hedge funds that started in the 80s and 90s were global macro funds, were traded essentially currencies and rates. And then as we got into this decade, a lot of the funds started out as being credit funds, and I think the perception of Canada is having these resource equity funds, and the perception is because most of them blew up because, as Jason said, they weren't really hedge funds. In fact, they were the opposite of hedge funds. They had volatilities way in excess of what the TXS was because they were long leveraged to do that. But we've run a high yield credit hedge fund since 2002, and I would say if you weighted the dollars in Canada in the hedge fund strategies, that credit funds over the last 20 years were probably as prevalent as the long-short resource funds. You just don't have that perception because they didn't blow up. I think that still the credit strategies are very, very conducive to long-short strategies because the things that you're hedging are much more identifiable. You're either hedging credit risk or interest rate risk or currency risk or all three. And how those risks react in certain market things are much more certain than what you find in the equity markets, where it's more difficult to hedge out risks in the equity markets because they tend to change more frequently. So I think that the one thing I would really say is that the hedge funds today are much more real hedge funds, and how I define a hedge fund is one that has a volatility that is significantly below its benchmark. And whether that be credit or equity, it doesn't really matter. I don't believe that you can run a hedge fund that has a volatility greater than its benchmark. That doesn't make any sense to me.
Okay, the last question in this part is predictions for the alternative industry in Canada in 2017. I think hearing what Barry said earlier about in his career, the level of uncertainty, so I'm kind of interested in hearing their comments on this one. So Barry, I'll let you start with that one.
Okay, well, of course it's going to grow. But I think you have to look at it cyclically, and the fact that the last 6 or 7 years, the central banks have been deploying policies that are designed to increase valuations and suppress volatility. And a lot of people have said hedge funds are dead and because they've underperformed the market. Well, they're supposed to underperform the market when the market is going up. And if you have the central banks doing something that's specifically working against the strategy, what you're trying to do, I think that the hedge fund performance have done exactly what they should have done in the last 5 or 6 years. But the Fed is no longer QEing. They're no longer targeting valuations and trying to create wealth effects. And I strongly believe that volatility, whether it be interest rate related, which I think is where it will start, and move to currencies and equities is going to increase significantly, and which it naturally does in every cycle. As you get later in the cycle and you move into the end of the cycle and into recession, that's what's going to happen. And we're getting close to that. I have no idea exactly how close we are because it's very difficult this cycle. But I think the need for hedge strategies and things that can reduce volatility while still generating returns can only grow in the next 2 or 3 years.
Jason?
Yeah, we would agree for sure, and think the market in Canada will continue to grow. But I think what's different is that if we do see a pullback in equity markets, because the S&P 500 is at lofty levels and is at high valuations, we will see further adoption of a market neutral or a more pure hedged approach. And 2008 is almost 10 years ago now, so everyone kind of doesn't. It feels like we forget about it, but it were pretty dark days and those pretty big drawdowns. So if we experience something, not to that effect, but you have a 5 or 10% correction in the market, how do people value a true long, short, and hedge product again?
Brian?
I think the other thing that's going on in the industry is changes to 81-102 that I think will allow prospectus-based hedge funds. And so that will really, for the first time, allow the big asset managers to create a hedge fund product. That's both good and bad. I mean, it certainly will help the education of the marketplace, but it'll also make it much more difficult for allocators like yourself to identify strategies and managers, because at the end of the day, the big asset managers are AUM gatherers. So the strategies may not be particular, they may be packaging strategies that don't lend themselves to scale. But I think we are definitely having an agreement that we're going to see more choices, more funds as the years go on.
Thanks, Brian. We're going to change to the case for hedge funds. And our first question is, in general, what opportunities do hedge funds present and what problems do they solve? And I might start again with Brian.
So I think when you're looking at a hedge fund, I think the naive assumption is that you're looking at it for the monstrous returns. When in fact, I think that's the wrong reason to pick hedge funds. As Barry pointed out, oftentimes it's about lower volatility. So I think when we designed our fund, what we did is we thought about what are some of the things or attributes that a portfolio manager would want, or somebody building a portfolio would want. And we looked at it and said, diversification. It's pretty tough to get today, so we thought having products that offer diversification are of value. Access to a return stream that's not available through traditional long only mandates, right? If you can design products that offer that type of like the private lending folks, et cetera, going down that route, those are just return streams you can't get anywhere else. And then lower volatility. I think that at the end of the day, volatility is a funny thing. If you're making 5%, 10%, 15% a month, nobody calls that volatile. But if you lose 2%, 3%, that's very freaking volatile. So I'd say low volatility. Volatility does cut both ways. But I think at the end of the day, most investors do like steadier returns rather than wilder ones. So if you can create a fund that has lower volatility, it ultimately has a place in many portfolios.
We would say very, very similar points, and really, I think investors the first thing they look at is volatility and Sharpe ratios, and that's kind of the true measure of a high quality manager. Return is great, but how much units of risk are you really taking to generate those returns? So that's what we pride ourselves on, and it's funny, one of our founders, Brad Dunkley, wrote a musing yesterday. I went out to all of our client base, and he was comparing kind of him and what Charlie Munger said, that Charlie Munger, of course, made tons of money, but he's lost half his wealth, I think 3 times in his investing career. He doesn't care because he's worth a bunch of money and had a 70-year time horizon, and so be it. But Brad's whole point is that he would trade an 8% return on the market for a 6% return if he knew he could sleep at night and not have 50% drawdowns during that time period. So that's really what kind of we're trying to drive home, and that's how we feel the best way to take care of our own money is.
Well, I'll make it unanimous. It's capital preservation and better risk-adjusted returns, which means controlling volatility and drawdowns. All of those things that nobody cares about until they care about it, and then, then they want to reward the people that did it. In 2008, our high yield fund lost 2% when its benchmark lost 40%. All we did is really short credit, the high yield credit default index, and bought 30-year treasury bonds and sell everything we could, and anything that we couldn't sell, we hedged by those two things. So it doesn't have to be complicated, but when markets correct and when we go into recessions, that's when people really value capital preservation. And I would argue that we're certainly closer to a recession than the start, given that 2008 was, as Jason said, 9 years ago now.
Thank you. So what are the three most important considerations for investors before they invest in a specific hedge fund? And I might start with Jason on this question.
So I feel like I'm a broken record here, but I'd pay particular attention to volatility, Sharpe, and return profile. And what type of product are you looking for? You're looking for a 25 to 30% return profile a year. Well, recognize what the product is, and if it is a sleep at night strategy and you do want 6 to 8% return, then focus your efforts there. Do your due diligence on the manager, meet with them. And that'd be kind of it, but it feels like a just generic, or it's kind of volatility, return, and Sharpe would be our three big things.
Okay, Brian?
So the way I would think about this is, when you're looking, I will say you're looking at a particular strategy, you already know what the strategy is. Then I think the first consideration is the quality of the team that you are going to have manage your capital. As we know in the industry, there's lots of strategies that are similar, but at the end of the day, the results to the investors are quite different, and that speaks to the quality of the team that's managing the money. The second thing is that, and this is kind of a weird one, but I'll throw it out there. We're a relatively new manager, so we would get this question a lot. Really, the folks or the management team, are they really running a business or is it a hobby? When we launched with our own money, and that was the first question we got. Are you guys doing this out of your basement? And do you wear pants when you go to work? Right? Like, what are you guys doing? And no, we had a very clearly laid out business plan. We showed it to some of our early investors, and at the end of the day, that helped us raise capital. And so I think at the end of the day, when you're an allocator, that's one of the considerations. And then the last thing that is really good to understand is under what environment will that manager have trouble generating returns or staying above zero. Every strategy is going to have a tailwind, and every strategy will have a headwind. And as an allocator, I think you want to understand those environments so you can understand how to assess the manager's performance when those conditions arise.
Yeah, I can't add a lot to that, really. I think you have to understand why you want a specific strategy, how it fits in with your total portfolio. Look at the performance of the manager and how they've done in periods where markets have had negative returns, and finally what is the long-term objective of what you're trying to do, and does this fit into that? And is that particular fund, how does it rank against other funds that did similar things? But in the bottom line is don't look at the good years, look at how things performed in the bad years and how did you preserve capital when other people lost it. I think that's the key.
Okay, the next question we want to talk about is the growing preference for passive versus active investing. Does it hurt or improve the case for adding hedge funds to your investment portfolio? So I'll start with Barry on that one.
Yeah, I guess I could argue that one both ways. The more it's obvious why the passive funds are gaining capital is because we're in a 8-year bull market and the people with the lowest fees have generated the best returns, and people are questioning whether active management is really worth it. That's typical. I don't think you can really compare investment returns unless you have a full cycle. We've gone through bull markets and bear markets and see how they did, and typically the passive investments have done poorly in down markets and have done better in that, so it's not surprising that in an 8-year bull market that a lot of people are choosing passive investments. But I would be severely shocked to suspect that we would have the next 8 years will be similar as the last 8 years. So I think it's kind of rear view mirror thing, and once you get through a full cycle, then people will be able to make that analysis, and active management does better in down markets, and passive management generally is more favor in up markets. That's the way it is.
I would say passive is much more subjective to material drawdowns, and I can see it in the energy space. And you think what we've gone through in energy in the last 2.5 years here, it's effectively been energy's 08 all over again. So we've had a full cycle to go through, and the drawdowns for the energy indices are 39%, and that's just material. Our worst drawdown's 5%, and that's the difference to us between passive and active. I think there's a place in portfolios for a lower volatility product and delivering alpha, and not just kind of going with the cheapest fee product out there.
I have a slightly different slant. I think what we're seeing is a trend that'll continue. It might slow down in a bad year, but I think what people have really understood, it's like that story about is the emperor wearing clothes, and what we're finding out is there are some managers that aren't wearing clothes and they're being exposed, and so any of the sort of asset gathering funds that get too big and are really closet indexers, people are rightfully saying, hey, wait a minute. I can get beta at 5 basis points. Why do I need to pay 150 or 200? And I think that trend will continue. And what it means, though, is if you're a true active manager, then from a share of wallet from the client, if they're now only paying 5 to 10 basis points for beta, true active managers can probably attract some attention. So I actually think it's actually beneficial for hedge funds because hedge funds are generally active managers. It's very difficult to run a hedge fund that's runs an index strategy. So I think it bodes well for the industry. The risk is this, though, which is kind of an interesting one, and we spend a lot of time worrying about it in the bond world, and I'm sure you've seen it more. You've seen it recently too, Barry. Is the growth of ETFs, while it creates opportunities because they're very mechanical in terms of execution, and you can understand what they're going to do and when they're going to do it, so it provides you opportunities to exploit them. The other thing, though, is that the flows when they're being redeemed just overwhelm everything. If anyone here owned preferred shares a year and a half ago, you've lived through that horror show, and that's when correlations go to 1. And so sometimes in some environments, those ETFs or the passive investors can actually create headaches for the likes of active managers, because all your correlations just go to 1, then hedges break down, so it can be complicated. But I think on balance, the trend is a good one for active managers, and I think it'll bode really well for hedge funds.
Thanks, Brian. The next question we have is the risk-reward trade-off worth it? For example, some institutions, notably CalPERS, has publicly withdrawn for the time being from hedge fund investments due to the struggling U.S. hedge fund index. So I'm going to start with Jason because he obviously showed how his fund has actually done better, and I just will ask to comment on that. Thanks.
So hedge funds serve a place in a portfolio, and it's again, I'll come back to volatility here, but it's truly what are you trying to do with your capital base, and what are your objectives? If your objectives are 6 to 8% return, and want to sleep at night, and don't want to see your capital go down in a material way, then hedge funds certainly serve a purpose. If there's a greater kind of return profile chase, where you want 20 to 30, or you name the number, recognize that incremental units of risk will have to be taken to generate that return. So yes, the kind of CalPERS of the world and a few others have pulled capital out of U.S. hedge funds, but I would say kind of think about their allocations to which fund as opposed to a blanket statement across the entire hedge fund universe.
Brian?
Well, what I would say is that, a lot of hedge funds are started and run by males, and so there's an awkward fixation on size, I guess. No, I mean, let's face it, you can become a billionaire running a hedge fund, not by generating by returns, but by going from a $1 billion fund to a $30 billion fund and charge 2 and 20. So there's a huge incentive for those funds to get bigger. The massive institutions, allocators all want institutional quality, operations, compliance, due diligence, so that raises the costs, and next thing you know, you have institutional size hedge funds. Problem is, the strategies that generate the returns are generally not scalable into that kind of size. So it's not really a surprise that, all of a sudden some of these folks go, wait a minute, I pay an awful lot to get 2%. And as Barry pointed out, we've been in a bull market for most asset classes. The S&P's up 30, I got 2. My manager took 3. What the hell's going on? So I think it's smart, it makes sense. In terms of when you're looking at hedge funds, it's really, some strategies are scalable into the billions, and some you have to stop them at 100 million. And that's really what an allocator has to try to decide, is when you're allocating hedge funds that are going to provide the return stream, the correlation or the volatility characteristics you want that are scaled properly, I would say are worth the fees that you're going to pay.
I don't think the question is whether you should have hedge funds or not have hedge funds. I think if you really look at the investment strategies in the long-only world in the last 10 to 15 years, they have become much more long-short, even though they're considered long-only strategies. The average mutual fund has more hedging tools and activity in it now than they've ever had. And I think the world has rebelled somewhat from hedge funds because of the fee structures. The fee structures were way too generous to the investment manager. As Brian said, you start a hedge fund, you become a billionaire, and the investors ended up with less returns than if they had invested in a passive ETF. That hardly seems fair. And if you're in a public sector entity like CalPERS and you're responsible to politicians, it's not surprising that they exited their hedge fund program to do that. But I think if you broadly look at hedge strategies and how they've evolved over the last 10 to 15 years, that it hasn't been that hedge funds have really gone down. It's more that the long-only strategies have been chipping away and getting more and more hedge components to that. The regulators haven't allowed mutual funds to become full hedge funds. That is expected to happen in 2017 in Canada, where they're going to have alternative mutual funds. And so I think that really tells you more about the value of hedging than looking at the accumulated capital within the hedge fund universe, that I think going forward, every investment strategy is going to look more like a hedge fund of 10 years ago than what a mutual fund would look like 10 years ago to do. And I think that really tells you the value of being able to hedge. And the point of hedging is to preserve capital and lower volatility. So who wouldn't want more of that?
Okay, we're going to move into sort of the last sort of section that we had for the panel is the winning hedge fund strategies, and each of our managers have award-winning hedge funds based on superior investment performance. And I guess the question we're going to ask is how and why did the firm launch, and then describe some of the key investment characteristics of the fund, and how are you adding value for your investors, and what separates your fund from your peers. So, Brian, at least right.
So my partner Raj touched upon this story, and he was not kidding. Our office was like 80 square feet. But what we were looking at when we wanted to look at our fund is we thought to ourselves, at the end of the day, we're going to have to rely on the high net worth market to raise the money in. What do those folks want? And what we thought is at the end of the day, a lot of those folks are entrepreneurs. They took a lot of risk to become rich, so they're probably interested in products that just help them keep rich. And when we looked at it, so we kind of designed the fund along the lines of what would make us happy. And so we said, hey, you know what, most people would like, inflation's 2%. If you can generate 6 to 8% consistent returns, that's probably going to satisfy a wide array of the investors. And then the other thing we looked at is volatility. As I already mentioned, nobody ever says anything's volatile when it's going up, but when it's going down, then that's that bad volatility. We don't like that. And then the last thing is that we said, hey, we do think correlations matter. All of us traded through 2008. I used to have hair back then, and I don't today. I lost a lot of it managing some very complicated derivative books for CIBC. So, and including a very sophisticated correlation book. And my partner Raj also ran a correlation book. So the word correlation comes up a lot in our conversation. So we wanted a low correlation. And so what we really thought is, we understand the bond market. That's where we grew up. We traded all those products. So we'll look at how do you generate returns using fixed income that should outperform traditional fixed income investments for quite a long period of time. And so that's how we came up with our fund. And we were acutely interested in solving the problem of rising interest rates. And how do you put something in the portfolio that's not affected by that? What's odd is so far since we've been running, the correlation of our fund to equities is actually around 0.6. However, to the bond index, it's virtually zero. So, November when Trump won and interest rates went out 50 basis points, that was not anything that we paid any attention to. We were more concerned about credit. In terms of what's different between our fund and our peers, because there are other folks out there running funds. The part of the strategy that Raj explained to you where we lever credit, that's very scalable. You could do it on billions of dollars if your banks will let you extend the credit. And you can generate that 5 to 7%. What's not scalable in the bond market is active trading. You can, that's what's going on with the VOCA rule and regulation. What's happened is prior to 2008, the banks and fixed income used to run two businesses. One was a moving business and one was a storage business. Now the banks don't want to be in the storage business. So they carry very few light inventories, and basically a lot of trading happens now more agency-like or by appointment. And so that means we can trade 5 million corporate bonds easily. You could trade 10 million. It's next to impossible to trade 25 million of an issue in one phone call. And so that's not scalable, and that's what's differentiated us against our peers. having a smaller fund has enabled us to be nimble, to move our risk up and down, and also when we spot an opportunity, we can exploit it, because oftentimes the opportunity is only available in a small amount of the securities.
Jason?
So the firm launched in the middle of 2010. It was launched by two founders, Brad Dunkley and Blair Levinsky. And when they went to go launch the firm, they said to themselves, how do we want to invest our own capital? And it's kind of sleep at night and protect it. And we don't want large drawdowns. It was 2010, so we're only, 18 months out of 08 here, not 10 years as we are today. So it was fresh in everyone's minds. And they said, can we do 6 to 8% return a year? Do we feel really good about that? And that's how we'd invest ourselves. So that was the genesis for the fund. And then in April 2015, we launched the energy product. And energy is somewhat similar to that. It's how do we invest in a sector that we know, that we understand, that we think there's incremental alpha in. And for one part, we think the short community within energy is small within Canada. So we think we have an edge in that respect. And two, there's no one really doing what we're doing in Canada, running a true market-neutral energy book in the sector. There are a handful of funds that do it in the U.S. There is one that does it on a much different platform and scale out west in Canada, but I don't think anyone that's running a true diversified, liquidity-conscious energy product in Canada. And that's really what differentiates us.
Barry? Okay, well, I guess I started running the first hedge fund I ran in 1987. World was very different back then, and when I started Merit in 2001, we started running long only and long short money pretty much from day one because we fundamentally believed that long short investing properly done would produce better risk-adjusted returns than long only over the long term, and that's actually true. If you look at our high yield funds, long only and long short, the long short funds have produced better risk-adjusted higher returns with less risk than long only, and the long only funds have beat their benchmark. So I would say right now, and we have the whole fixed income spectrum. We have a cash substitute fund, we have an investment grade long short fund, we have a high yield long short fund, and we have a distressed fund, and we have over $4.5 billion in assets that are growing every day. So the reason we have those that lineup is so that we can always have something that we think the market currently favors. And right now, I would say the market favors cash substitute because valuations are so rich and people need a place to reduce risk. However they're taking that equity risk to do that. We're pretty positive on long short investment grade. We're not positive on long short high yield right now. We think high yield is overvalued, as just like equities are. And our distressed funds we see as very, very tactical. If you looked at the distressed index, over 30 years, the return on distressed debt has been 0. But 20 of the 30 years, either the market has gone up more than 50% or down more than 30%. So you have very high volatility in the asset class with 0 return in the end. That tells us it should be a tactical asset class. It's difficult to hedge. There isn't a natural hedge against distressed credit spreads. So therefore you look at it tactically. And we looked at energy, distressed energy last year as a tactical play. We did very well with it. We sold everything in November of last year and gave all our clients the money back. I think there's another opportunity coming in U.S. healthcare, but it's not there yet. So I would say that we're not quite ready to recommend distressed, and we're not favoring high yield, but we do like investment grade and we do like short duration credit here.
The credit space has enjoyed a 10-year plus period of providing oversized returns for investors. What is the outlook for the credit and rate space for the next few years, and which macro factors will threaten or limit your alpha generating ability? And this will be for Barry and for Brian.
Okay, well, if we go into recession in the next 3 years, which I think is reasonable expectation, credit spreads are going to widen and you're going to lose money if you're long credit, and you're going to make money if you're short credit. If you're short credit, you might still lose money because there's a negative carry to do that. So I think you have to be careful of strategies that you're exposed to long credit here. And it's always tougher to make money shorting anything, but when you're shorting something with a yield, it's even harder to make money to do that. So I think that I'm comfortable with long exposures for 2017. I'm not sure about 2018 or 2019 yet. I think one of those 2 years you might likely have to have a short exposure to credit to make money.
So I agree with, so I'll start off with Benjamin's call for higher interest rates. That's our call as well. We think that rates will gravitate higher. They're probably still lower than, especially U.S. rates are probably still lower than they would likely be, given that the Fed is moving and the U.S. fiscal policy is inflationary. And that's largely because the ECB and the Bank of Japan are still conducting quantitative easing programs. I would think the ECB is going to stop theirs or curtail theirs even further this year, and that will allow yields to rise there. So what does this mean? It means really traditional fixed income returns are going to be uninteresting, to say the least. In terms of credit, I'd echo what Barry said. I think it's still attractive, but it's not the sort of, it's not, markets, credit was cheaper in this time last year. Right now, when we look at our metrics, the triple B spreads, a generic 5-year triple B spread is about 8 or 9, probably 13 basis points through the median, or tighter than the median that we've seen since 2010. I always like to strip out 2008 from these calculations because it skews everything. It doesn't make sense. So we think credit's a little tight, but not overly expensive. But what we've been doing in our fund is we've shrunk our credit duration. We think that last year was largely about momentum, whether it was in general spreads or from one sector to the next. We don't see a huge move to tighter credit from investment grade credit today. I mean, there's going to be a little bit probably, but it's not going to be what it was last year. I think instead it's going to be sector rotation this year. There'll be differences between sectors, et cetera, and I think that's the game for 2017. I would say that I do agree with both Benjamin and Barry are saying, you know what, at some point in time, whether it's 2018, 2019, we've got to see some drop in economic activity, or certainly some drop in the markets anyway. And it is tough to be short. The easier market to be short in is something like 2008, where credit spreads go a long way. But to just put it in perspective, if you're owning 3-year bonds levered 4 times and you're earning 6% yield, even a 50, 60, 70 base point credit spread move wider still leaves the fund in positive territory. So being short credit can be a very difficult trade. Largely in January of last year, when credit spreads were around 50, we were still positive and we were still long credit. It was 9-month bonds we were long. So I think you've got to run a shorter duration, credit duration this year, and certainly next year.
Thanks, Brian. This is a question for Jason. What is the role of your strategy in your investment portfolio if you pertain to a market-neutral energy strategy in an investment portfolio?
Yes, so as we kind of spoke about, that energy is incredibly relevant to Canada. It represents 20% of our index, and think about the economic activity associated with it too. So I think on one hand, we view the investment thesis for the fund in two parts. One would be, do you want energy exposure? And it really is energy without the drama. It's 6% volatility versus 15, and that's what we're trying to deliver. That'd be one component. So trying to fill an energy component of your portfolio. And two would be, take out the sector, take out the word energy. It's just alpha. We're just trying to deliver alpha in a specific sector. Call it the market, call it healthcare, call it whatever, but we're separating good from bad and really trying to distinguish here the opportunity set in the market. There is a great universe to short stocks in this country and in the US. It's not a market, shorting is not often done by the mass market here, so we do have an opportunity on that side, and it's just hedging risk and really at the end of the day generating alpha in a specific sector, agnostic to whatever the sector is.
Thanks, Jason. So this is a question for all three of you, is to what investment strategy problem does your fund represent a solution, and then what typical portfolio investment are best replaced by your fund and why? So I'll start with Brian.
So we think our fund I'll start off, it is an alternative fund, so don't jump on me for saying this. But it helps you solve the problem in your fixed income portfolios where you're struggling to say, hey, what the hell can I put? I want something with a higher yield or return that is at least somewhat related to fixed income. And we think that's what our fund does. And you have the beauty about that the fund is not, if interest rates move up or down, our ability to generate returns are largely independent to that.
Okay.
So similar to my previous answer, I'd say twofold. One, it is, if you do have an energy sleeve in your portfolio, it is energy without the drama, so it fits that mold very nicely. So that would be kind of one component, and again, it's just, do you have a lower volatility way to get exposure to equity markets, and this would certainly be one of them. It's just running a much less volatile, lower drawdown opportunity set to equity markets, albeit it does have some bent and tilt to one specific sector.
Yeah, I think ours is really simple. If you want less exposure to the equity market and you want a place to hang out and earn a reasonable return until you get the inevitable corrections in the market, that's one, and we see it as a alternative to core fixed income funds that have 2.5% yields and 7-year duration. This is something that's producing 5% return with a 1-year duration. Either one of those is, I think, a reasonable thing to do in this market.
So here's the loaded question for the afternoon. What is the black swan risk in your strategy, and in what market environment would be the most difficult to avoid losses? I'll leave it to either one of you to start.
I guess I'll go through. I think that the black swan is obviously either something that comes out of left field like 9/11, or something that causes a recession, a really sudden, unexpected recession, before we've had a chance to hedge credit exposure and actually increase duration. So those are the kind of things that in our fund we've got the mandate designed to deal with it. It's just whether it happens so quickly that we don't get a chance to gradually move the portfolio into less exposure to credit spreads and more exposure to duration. Which could happen any time. I think it's a low probability, but things can come out of left field sure in any point.
I feel like I lived through the black swan the last couple of years. It's oil was $100 for give or take 5 years, and everything. The world was great, And then we saw $26 oil twice in early 2016, so it was January and February. So we've lived through it for sure, but I tell you, big macro surprises or big oil market surprises are kind of what we think about black swan. So if you think back to late September, the surprise OPEC announcement to cut production was a big mover in the markets and sentiment and everything kind of related to energy. The most difficult, I think, challenging markets for us is extremely volatile markets. And today was a good example of that. Markets were down, oil was down 5% today for really not that great reasons, but just kind of people got scared out. There's record net length, they call it, in oil, and kind of chips were taken off the table, and just extreme volatility. So a down 5% event today and an up 4% event tomorrow tends to be a challenging market to go to. So what we tend to do in those circumstances is we go to cash. So we'll cover our shorts, we'll sell our longs, and we'll be much more cash waiting for a better opportunity set. We had a good 2016, but the end of 2016 became challenging with a bunch of big macro events that happened. So our gross exposure, which was our longs plus our short exposure total, averaged 180% for the year, and in December went to 100. So when times aren't good, we just tend to shrink and wait for more opportune times for our strategy.
In terms of the environment that's tough on our fund, I'll start off with what's the obvious one, which is a dramatic widening in credit spreads. But I will put the caveat on that is that it has to be it has to occur over a short period of time. My partner Raj was trading a very complicated credit derivative book in TD London. He made $50 million in 2008 because he got really short, right? So I think there are opportunities with funds to make money in those markets. But the trouble is what we're learning in a connected world, markets move, like the market reaction to bad news, or when it decides to move to bad news, because it doesn't always move now, it happens to be very vicious and very quickly. So I think that's something we are cognizant of. But there's another market that's actually, I think, would be more challenging. And that's a market that's, where credit spreads are widening, but they're not widening fast enough, so it's hard to be short, because to Barry's point, being short means you're paying a lot of coupon, but being long, you're basically losing all the coupon you're earning to the credit spread widening. And I think that's the kind of market where you're kind of, as a manager, you're struggling because you're damned if you're damned if you're short, you're damned if you're long. And so that one actually runs the risk of a manager error where you make some bad trading decisions and you end up losing a bit more than you probably would have had you do nothing. And I think that's what we kind of worry about on a regular basis.
Thanks. I guess, Brian, this is a question for you. As a smaller emerging manager who invests across a spectrum of securities, what are the opportunities that you're able to pursue relative to larger managers, and what are some of the particular challenges you face?
Right. So as many of you folks in this room know, there are some well-established folks in the leveraged credit game, and they're running billion-dollar-plus funds. And so, the question is, and investors ask us, so, I have that choice, why the heck would I care about you guys? And this is where we talk about the bond market. The bond market, you can get on your phone right now, you can buy and sell stocks, you can buy and sell shoes, you can do all kinds of things on your phone. Oddly enough, you still cannot get on your phone or your computer and buy and sell bonds at an institutional price. Which is kind of weird, but that's the bond market. It's opaque. It's still a people market. And so at the end of the day, you have to have relationships with the bond desk, the salespeople. It's an over-the-counter market. Not everyone has the same price. And so there's a lot of cracks for former market makers to take advantage of inefficiencies. There's rules the banks operate under, such as aged inventory. They got to blow stuff out at a discount price. They want to risk share because, as I mentioned, they don't want to be in the storage business anymore. They want to be in the moving business. And so as a smaller, but the positions that we're talking about are 5 million, 10 million. They're never 50 million or 100 million. So what happens is when you're a smaller manager, and as Raj pointed out, we're trying to generate 200 to 500 basis points of excess return or extra return through active trading, having a smaller fund means that we can just take advantage of that many more opportunities that have a meaningful impact on the return to the investors.
Thanks, Brian. So in summary, please give us 3 reasons why your strategy shows compelling prospects for the next 1 to 2 years and the top macro factor that would be biggest threat to achieving success for the investors. I'll start with you, Brian, or Barry.
Well, I think the 3 reasons. One, really exceptional risk-adjusted returns, got a long-term track record, and have a substantial asset base. Again, I still think that the biggest risk is you get a significant dislocation in markets, which is the markets are vulnerable because of the valuations that we're dealing with. And if we get a sudden change in people's perceptions of what the economies are going to do and flow that through into earnings, I think you could get a very sharp dislocation in markets, and that's why we're keeping the higher valuations go. We think the risk of that is higher, and that's why we're running very defensive portfolios right now. If we get some reasonable correction in markets, even 5-7% in the equity markets, then we'll become less defensive. But we're always cognizant of where we are in the credit cycle, and we're not at the beginning. We don't think we're in the middle. We're somewhere closer to the end, but that could take 2 to 3 years. We're not really sure. So we just have to manage that risk going forward and continue to produce the kind of returns that our clients want. And most importantly, the number one thing we do is we must outperform in down markets. Whenever we have a down month, we have to outperform markets. And if we don't do that, then we're doing something wrong.
So I would say for our strategy, energy specific, oil's recovering. We're not that far off supply-demand equilibrium. The world produces 97 million barrels a day. The world consumes 97 million barrels a day. A year ago, that gap would have been 1 million barrels. So we're moving in the right direction. The challenge is why oil price hasn't recovered fast enough now is it's simply based on inventories. So we're sitting with 300 or 400 million barrels sitting either A, in storage tanks somewhere in the world, or B, in a boat floating in the middle of the ocean because you can't find storage on land. So the world needs to chew that through. So that's what OPEC effectively has designed their cut to do, is that it's going to blow down inventories and the world stabilizes again from an oil perspective. So we're going to participate in that. We think we have the capability to pick the winners from the losers. If oil is capped at $60, there's a lot of losers out there. The oil sands don't really work. It's a high cost business with billions upon billions of dollars of upfront fixed costs. So there was a project Imperial Oil built, which is basically 2/3 owned by Exxon. They spent $15 billion building this project, and it's worked at 70% of design capacity since they brought it on 2 years ago. It's just, these are big, massive projects that require a lot of capital. So in a $60 world, you're not going to go sanction $15 billion of new projects, i.e. on a single project. And if we're wrong and oil doesn't recover and doesn't correct itself, we're protected on the downside. So we participate, and we think our losers really underperform our winners. So a company with 5 turns of leverage on their balance sheet that needs $60 to work really is disadvantaged in a $40 world, and that $100 or 100 bankruptcies that we've seen to date may grow, and we're happy to make our returns on the short side of the portfolio, which is really what we did in the second half of 14 and all of 15. And then whether we're right or wrong on oil prices, whatever which direction they move, I can't stress enough the winners and the losers. This is an industry where teams that have high-quality assets that can generate really high levels of return by putting capital back in the ground, they win because their assets are good. And again, we're talking about assets that are 2 miles underground and maybe 50 feet thick in rock that doesn't flow oil unless you pump down, millions of gallons of water and sand together. So there's a lot of technology involved here. So the winners and the losers really separate out. And then kind of the macro case, which it really comes down to commodity prices. So what ends up happening here, and how does that change the game? There was a famous CEO who's actually just retired at the end of last year. But he said if OPEC doesn't extend their cut for the balance of the year, we're going back to $40. So that's part of the scare that the market sees today. But these are big moves. So we were $55 on January 1st or 3rd or whatever the first day of the year was. If we go back to 40, it's a 30% correction. And all these businesses are fixed cost businesses. So you pay your people, you pay electricity prices to run your pump jacks, you pay your trucks to transport your oil to your pipeline. So the cash flow profile evaporates real quickly because it truly is a operating leverage business.
So 3 reasons to invest with us. Okay. Well, I'll start off with, does anyone in this room remember when mortgage rates were 13%? A 5-year mortgage rate was 13%? Okay, I don't think we'll see, when we talk about rates going higher, I don't think they're going that much higher. So so I think even though yields do go a bit higher, they're still going to be uninteresting. They're going to remain far below levels we saw prior to 2008. To give you a sense of what I mean by that, I traded government bonds as a derivative trader for years, and a large portion of my career, 2-year Canada government Canadas or 2-year U.S. Treasuries, you got a 5% yield. Today we call that high yield. Sorry, Barry. It's true. So I think yields will still not be high enough to, so where it'd be pretty easy to get an interesting return just out of owning a bunch of bonds. I do think, despite the recent moves in credit, investment-grade credit continues to offer good risk-adjusted returns, and largely because I think, for the most part, lenders, or if you ever talk to a bank lender or what have you, they're like the most conservative people in the face of the earth. They will still, when we talk about them getting loose with credit, et cetera, it's usually at the margin. So I think that generally speaking, investment-grade credit will remain a good risk-adjusted return. And lastly, I think our fund, because of the fact that we hedge out interest rate risk, that having that diversification of portfolio is just always going to be useful, right? Especially in a world where it's hard to get diversified. So I think that's the reasons why our fund makes sense. In terms of the macro factor that makes it tough for us, I think it's that sort of middling recession where you're damned if you're long and if you're damned if you're short. That's it.
Thanks, Brian. I do have some other questions, but I thought we would open up to the floor to see if there were any questions from any of you in the audience. And if so, either if you've written your questions down, you can bring them up to the front, or if you want to stand up and ask your question, please do. Those lights are hard. Mary.
I have a question for you, Barry. Clearly, in your experience, you know what high net worth investors are looking for. And I just wonder, do you think your high net worth investors understand and have an appreciation for what your mandate can do for their portfolios?
Can you please repeat? Yeah, sure. I think the question is do we believe that high net worth investors really understand what they're investing in? Is that the...
Well, I guess that's part of it, yeah.
Yeah, I think that generally I would say no. And the average high net worth investor that we interact with, has made a lot of money doing something they were very good at. And when they sold that business, they really felt like then they were retiring and they were going to turn it over to somebody else, whether an advisor or a family office person or whatever, and they were going to go to the beach. And unfortunately, that isn't true. What happens is they're actually in a new business, and they're actually in the capital allocation or asset management business, which they generally feel uncomfortable with and don't really wish to be in that business. They get a lot of advice, a lot of it conflicting, and they're not really sure what to do. I see a lot of the people that end up, chasing returns of things that have done well in the last 2 or 3 years, but probably are overvalued today. And it's really difficult for people in that position because they're uncertain as to what to do. They're uncertain who to trust. And oftentimes what happens is they will split their portfolio amongst 3 or 4 people, hoping that they're getting diversification, and often those 3 or 4 portfolios end up looking exactly the same to do that. So it depends on the size of your portfolio, but if you have a sizable portfolio of 50 million or above, I think you really actually should hire somebody directly to be your family office person who can then, as a professional, to look to allocate. If the amounts are 10 to 20 million, then I think that you should look and see if you can find 2 or 3 people that are doing very different things, but all have very good risk-adjusted returns. Would be my best advice to do that. But certainly get exposure to different asset classes, and I think you really should focus on long-short strategies, given where we are in the cycle. Being long only seems pretty risky to me.
Are there any other questions? Can't see any. Okay, I'll ask one more question and then maybe we'll wrap it up. Gotta put my glasses back on. It was one that was based on how do you make your portfolio decisions and what is the process? I think that might be helpful for people here. So we'll start with Brian.
So in order to construct our portfolio, what we tend to rely on is analysis of the company's ability to repay the interest and the principal. And we stick largely, being a small firm, what we do is we stick to our the names that we've traded a lot as market makers, particularly Greg. And so we follow probably 60, 70 names, because trying to branch out beyond that is a bit difficult. And what we're really looking for is, we're talking about things like TD Bank and, Rogers, Bell Canada. This is not esoteric by any means. But what we're really looking at is, are they changing their business model? Are they changing their leverage? Things like that will dramatically alter their credit spread. Because by and large, it doesn't really matter an earnings miss or an earnings beat. It doesn't really affect the corporate bond market all that much. So we tend to focus and look for the significant things. Where we've spent a ton of time, and this is where I get involved in, is if we decide we're going to have a concentrated position in a difficult name, and not that, and when I mean difficult, something unique has happened and the bond market's reacted. And the big example there was Volkswagen with the scandal. In last year, we didn't own any Volkswagen bonds because they traded at a credit spread that was too tight. That was not that it was too tight fundamentally, it's just too tight to interest us. And the 5-year bonds dropped $4 in 24 hours. And I mean, we traded from the short side for a couple of hours, and then we thought, wait a minute, that's a heck of a lot of it's a big move. So we actually sat down, we did a lot of work, and then we concluded that Volkswagen was actually really cheap, especially their 18-month and under bonds, because we said, it doesn't really matter whether they get sued or whatever, it takes years for that to happen. We're going to get all our coupon and principal in these bonds. that became a 15% position in our portfolio. So we'll do, you know, so we do a lot of all our own analysis, but we do have to rely on some of the material that's provided by the banks.
So we're fundamental investors, and we build models in every company we invest in. We have 65 models of basically every oil and gas company in Canada and the US, and we let the markets dictate the commodity price that runs through our portfolio, our models are. So we use strip pricing. That's kind of rule number one that I went through. We don't forecast commodity prices, so why not let the market tell you what the oil price is going to be in 2018? That's what we go by. We then stress test it. What does the business look like in a $65 world? What does the business look like in a $40 world? You'll change your weights and your allocation to a specific name accordingly. And then because so much capital is needed in this business, and as I said, 30% of your business disappears every year from the wells just get worse and they produce less. So you need so much capital to go back in the ground just to get back to the place that we were on January 1st every year. So return on capital employed is particular focus for us. So are we buying quality? Are we buying high allocators of capital? And then we build the portfolio fundamentally. So what we like goes on the long side, what we don't like on the short side. But then because risk is such a big focus for us, we see what the summation of all the risks of our positions are. So do we have a massive short interest tilt? Are we short the same names that everyone else is? I don't want that. So on days when we have high covering in the market, is our short portfolio going to materially outperform our long? So we'll go maybe do a screen for high short interest names and counteract that factor exposure. So, or think about market cap exposure or different commodity tilt exposure or momentum or change we pay particular attention to cash flow per share changes. So I want to own businesses and have a skew in the portfolio to cash flow per share increasing over time. So we're fundamental investors, but then have a pretty significant risk overlay on top of it, which drives a lot of capital allocation decisions for us.
I'll see if I can describe in 1 minute what takes us about 3 or 4 weeks to do practically for one company, but we have a blend of top down and bottom up. We start with the top down. We create all our macro scenarios the way we think it's going to play out for a year. You know, what interest rates are going to do, what commodities are going to do, what currencies are going to do, so on. Out of that, we come out with an industry overweight and underweight scenario. And then we go bottom up, and we actually like to find really good companies in poor industries because I think the relative value of those is generally very attractive. And we will look for even industries that we don't like coming out of our macro scenario. We will look for the 2 or 3 best companies in there, and we'll look for ones that 2 or 3 that we think are the most overvalued, and they become short candidates. So that's as best as I can simplify it, I think.
Well, that brings us to the end of the panel discussion. Unless there's any other questions, I'd like to certainly thank Barry, Jason, and Brian for very insightful answers to questions, and I'd like everyone to give them a round of applause.
Excellent. So thanks again to the panel. Brooke, thank you to all of you for attending. My personal thanks to Julie. Julie, it's a pleasure to work with you, and I love what you do for the industry, and I'm looking forward to continuing to work with you in the future. Julie's on her way up to the front with the draw bowl for the prize, so if you haven't put your business card in, please do that, and I'm going to be picking it, so... And it looks like I did a great job as MC because we're all going to get a refreshment 10 minutes earlier than was on the agenda. So